Good afternoon, everyone. My name is Larry Stern. I'm a U.S. CPA practicing here in Israel with Aboulafia, Avital, Shrensky and company. I'm going to expound on what Monty was talking a little while ago, and basically put a little more in the way of numbers and explanation of how the repatriation tax works conceptually, numerically, and as well as the GILTI tax. It's important to say up front that there's still clarification being issued by the IRS on a pretty much daily basis, okay? There's a lot of information here that's unknown. Things that I'm going to say here today may or may not remain this way based on IRS guidance, okay? So what I'm going to be talking about today is based on our best understanding of the circumstance as it remains today, as it exists today. Now, I found it interesting that with regards to this, you have the good old picture of Uncle Sam and saying paying taxes is patriotic, and I truly believe that it is patriotic if it's accurate and right to owe that money. However, in this case, it's not exactly the circumstance. The idea that we expats are subject, and our clients are subject to these difficult taxes and implications that were primarily unexpected, okay? This was not what the IRS appears to have intended, or the Congress appears to have intended. It actually makes logical sense that when as Monty explained earlier, U.S. persons, both individuals and corporations, until 2017 or at the end of 2017, are subject to worldwide taxation. Corporations are being moved to a territorial taxation system, so it makes sense that there is a transition, and I'm going to use the word transition tax at times in lieu of repatriation tax. But it's really a transition tax to move from a global taxation system to a territorial system for the corporations, and that the individuals throughout this process were kind of inadvertently included in these problems, or in this process, I should say. The agenda for this next session, which lasts about a half an hour and we'll take questions as well, is to go over the repatriation tax, explain what it is, how it's calculated, and give you an example. And for GILTI, give you an explanation and an example as well. Okay. The repatriation tax, there are different parts to this. There's the payment side of it, the actual cash payment that's due for this repatriation tax. And an election over which period you want the tax to be paid, okay? The IRS, or the Congress, I'm going to use them interchangeably in this case, provided an option, because this is a one-time tax, to pay it over a period of 8 years. For the first 5 years, it would be 8% of the tax due in years 1 through 5. That gets us to 40%. 15% in year 6, 20% in year 7, and 25% in year 8. So the tax gets split in a non-even way. In order to elect, you have to elect to choose, you have to elect in order to pay this over time. That election is an election that's done as part of the 2017 tax return filing, okay? How that election is to be made is not yet clear. But since the IRS's forms for the 2017 tax return for this aspect haven't been released yet, obviously no one that is subject to these rules can actually file their tax returns at the moment. Nevertheless, payment is due by the original due date of the tax return. And there's some question whether that interpretation of what that due date is. Obviously, U.S. citizens are required to file their tax returns by April 15th. Expatriates, people who are bona fide residents outside the U.S., are granted an automatic extension without request to June 15th. So the question arises, is the expatriate's tax deadline really April 15th or June 15th, because there's no special request being made. There's no guidance out there, at least not that I've seen at this point, that determines when that deadline for payment actually is. Obviously, to be conservative, it's best to make any estimated payment for these taxes by April 15th. Again, there's a lack of clarity about how these calculations really need to be done and what is included in those calculations. So you do your best, at least at this point, to come up with an estimated figure of if you're going to pay the tax, do it by April 15th and have that ability to split the tax payment. Otherwise, 100% of the tax becomes due this year, and then you're subject to penalties and interest and everything else on the non-payment of the tax. In addition, seizing business operations at any point in time, let's assume you've made the election to pay the tax over 8 years. If you seize your business or sell your business, under most circumstances, could even create an acceleration of the payment of the transition tax, okay, the repatriation tax. Okay, how do you actually do the calculation? There are a number of factors that need to be looked at in order for the calculation to be performed. I'm doing this from more from an upper level, 30,000 feet, because there's a lot of the detail that's not yet clarified. But when you do the calculation, you're going to need to take a measurement of the E&P, or earnings and profits of the company. If a person has more than one company, and one company has profits and one company has a deficit for earnings and profits, those can offset each other. In other words, because the taxation is at the owner level of these foreign companies, these CFCs, you can offset the losses in the earnings and profit losses in one company against the earnings and profits earnings in another company. So the owner would be subject to tax only on the net difference. In addition, as Monty said, that the tax rates for corporations 15.5% or 8%, or for individuals 17.5% and 9%, differ whether these are looking at cash assets or non-cash assets. Okay? We're going to need to define what are considered cash assets, because if you don't know what a cash asset is, you don't know which rate to apply. Okay? And there are a number of differences, as Monty started pointing out, and again, this goes back to the point that really this was not the intention, or appears not to have been the intention of Congress to assess these taxes. There's some significant differences between when you have a corporate ownership and individual ownership of these CFCs, these controlled foreign corporations. Differences include dividend deductions, foreign tax credits, indirect primarily, and the maximum tax rate used. We see that the tax rate is actually higher for individuals. And as I mentioned earlier, the calculations are going to be done on Form 5471. The IRS has not, at least not since December, released a draft new 5471. They have not released new instructions for the 5471. So there's a lot of things on hold, and at least the hope in the near future is to get the IRS to say, stop. We haven't given enough guidance yet for people to pay this. How do we mandate them to make this payment by April 15th or possibly June 15th? But that's part of what the active, when we're trying to be active in trying to get change with the IRS, we have to take it step by step. First things first, give us the ability to calculate this tax, if it's even going to be assessed. Obviously, the preferred option is to get rid of this elephant for individuals, but we're not there yet. Okay? As I was just explaining, there's a difference in tax rates. How do they arrive at the higher rate for the individuals? You're basically saying the individual has a maximum rate of 39.6%. Okay? If we're talking about cash assets, the corporate rate for both cash and non-cash assets would normally be 35%. This is before the reform. You take the excess of the individual over the corporate rate. In other words, 39.6% is 113% of 35%. Multiply that by the 15.5% corporate rate for the cash, and you come up with 17.5% for the individual rate. Non-cash, same thing, 113%, multiply it by the 8% tax on non-cash assets, and you get to a 9.05% tax rate. It's insane. Okay? Going back to the question that we were talking about, because the tax rates differ between cash and non-cash, we need to identify what is considered cash, aside from physical cash, okay? The IRS doesn't, or the code section doesn't limit it to specific actual cash. They say that net accounts receivable less accounts payable is considered cash. In essence, anything short-term is going to be considered cash. Foreign currency holdings are considered cash. Short-term obligations, commercial paper, CDs, government securities, as well as traded personal property, which may include things like stock, which, as long as there's an established market for trading it, like you can go to the stock market tomorrow and trade it in for cash. So all of those things, for purposes of our 15.5% or 17.5% tax rate, are considered cash. Foreign currency exchange rates. Well, since we're talking about foreign currency being considered cash, at what date do you actually convert the value of those currencies? So that is always going to be December 31st of 2017, regardless of whether you're using an EMP rate balance as of October 31st or November 2nd or December 31st. One other nuance that can really impact people, and you'd think that after something like this tax reform, assuming that this doesn't get changed, people would definitely consider possibly expatriating, giving up their US citizenship. But there is a clause in this tax reform that basically says they're going to assess a tax recapture of 35% at a 35% recapture tax rate. For anyone expatriating, or any shareholder expatriating, and I'll explain how that applies to corporations in a second. Any expatriation before 10 years from the date of the legislation, so December 22nd, 2027. You can have a situation with a corporation, corporate ownership as well, that is considered expatriation when you have what's called an inversion. Okay, you have a situation where you take a US company that holds an Israeli company and invert it, have a transaction so that the subsidiary becomes the parent company. When the subsidiary becomes a parent company, you're basically expatriating the US corporation from US taxation. That would also fall under this 35% repatriation tax rate. Let's take an example, okay? And I'm going to focus primarily on an individual, okay? Because we really, most of the people that we're looking at here are either tax professionals or individual owners of foreign corporations, of CFCs. So our example is as follows. US person, USP, owns 100% of each of foreign corporations CFC1 and CFC2. Both corporations are located in Israel and are denominated in Israeli shekel. CFC1 has an EAP deficit, so a loss, of $260, while CFC2 has a profit of $400. As we said earlier, and all of these holdings are actually in cash to make our lives a little bit easier and not having to differentiate between the 15.5% and the 8% rates. So the first thing we do is we offset the net loss against the net gain, the EMP loss against the EMP gain, to give us our net EMP for purposes of the repatriation tax. The entire $400, the $260 and the sorry, I think I said that incorrectly. The entire $400 is considered previously taxed income, either because of the loss offset or because of the repatriation tax that is going to be subjected to. Now, what does it mean, previously taxed income? That in the future, when that money gets dispersed from these CFCs, it would not be subject to additional taxation in the US. So taking our example, we have a tax on our $140. You have tax of $24.50 at 17.5% for an individual with cash assets, which, if elected, could be payable over 8 years. Excuse me. Okay. When the amounts are small, it doesn't sound so big, but when you add zeros to the end of this, it becomes a little bit more prominent, shall we say. Okay, so, you know, it was brought up before, the idea of distributing dividends to possibly offset this. As Monty was saying, there are solutions out there. Some of them may be still available in terms of using certain IRS code sections, foreign tax credits, or many other options that are available that may be available to work through this. But each case really needs to be looked at on a very individual basis and planned for that specific entity's options. Okay? Yes, go ahead.
I know that's a tax because there would have to be an income inclusion on line 21, I assume, I mean, it's not taxed separately. You have to somehow figure out how much.
We would have to look at the methodology because it's supposed to come through on the 5471. You may actually calculate the tax there before.
And you would have to basically figure out what number it's 24 and a half. You have to gross it up and work backwards, but I'm trying to make this easy for purposes of understanding the concepts. The calculation itself, like it was just said. Higher than that if someone's taxed at a higher tax rate.
37% is the maximum rate for an individual, so it can't really be higher than that for this purpose. So sorry, 39.6. Excuse me, 39.6, not 37.
This is what percent? This is 20. This is what? This is
17.5%, which accounts for the difference between the 37 and the 39.6 tax rate. So it kind of takes that into account. It's not, look, nobody's going to sit there with an Excel spreadsheet and say, okay, here's our bottom line number, multiply it by 17.54%, and that's the end of it. This is obviously a much more complicated calculation. But I do foresee, at least if this continues this way, that on the 5471, similar to what we have with subpart F tax calculations, there'll be a schedule that will require you to then fill that out and get to a tax rate that is appropriate for that level of taxation.
They put it on page 2 as another tax.
Right, it could be on page 2 as other tax, just like subpart F income would be reported. So the calculation may not be listed on line 21 as other income, but may be flowing through from form 5471 with a final tax number but we don't know. Again, the forms are not out there. This is an educated guess on my part. Until we actually see the updated forms and the calculation methodology from the IRS, it's going to be impossible to know. Okay, let's move on to GILTI. As Monty explained, GILTI is global intangible low taxed income. Okay, it's basically tax on the business income of a CFC, even if the profits remain within the CFC. And as we were discussing, it's piercing, in essence, the corporate veil, but allocating that income to its owner. Okay, and as Monty said, it's for tax years beginning on or after January 1st, 2018. Now, there are some significant differences between individuals and corporations in respect to this. Corporations are entitled to deductions and indirect foreign tax credits to arrive at a minimum global tax rate of 10.5%. Okay, that is something that, you know, I can understand that at the corporate level, that you want to create a global minimum tax. You don't want corporations to be able to hide money in offshore accounts and not pay a minimum amount of tax. We actually see that in our current tax legislation for what's called alternative minimum tax, okay, for individuals. Whether that has been fairly adjusted over time is a different question, but the concept of somebody paying their fair share of taxes in that respect is reasonable. However, when it comes to individuals, they're not eligible for these deductions, and they're not eligible for indirect foreign tax credits, and therefore may have to pay individual tax at personal income tax rates on income that hasn't been distributed from a foreign corporation to which the US should not have taxing rights for. Okay? There are other areas that are very much unclear at this point of how they're going to be impacted by this additional GILTI income that's going to be reported on a person's tax return. What's going to happen for state and local taxes? Is that considered income for state and local purposes? There hasn't been any guidance on that. Is this considered passive income and subject to the net investment income tax, or Obamacare as it's sometimes known, 3.8%? That's also unclear. There hasn't been guidance on those issues. As with the transition tax, any amount that's reported as income for GILTI purposes in a given year, when that money is then distributed from the foreign company, it would not be subject to tax again upon distribution. And like I said, for GILTI, the specific calculation methodology hasn't been fully released yet by the IRS. My feeling is that they're more focused on the transition tax, which is more of an immediate issue. GILTI is a more forward-looking issue at this point. Let's take an example. US company and US person. So you have one corporate entity and one individual entity. Both own 50% of CFC1. Okay? CFC1 has $200 of non-ECI, non-subpart F income. So regular business income. Okay? CFC1 owes 20% of tax at a rate of 10% on this income in its country of establishment and country of operations. Let's look at the difference between the taxation for a US company and US person. Okay? The GILTI income in both of these circumstances is $100, the $200 of net profit. Okay? And for US corporation, they're entitled to a 50% deduction, which goes down to 37.5% after 2025. But for now, a 50% deduction, automatic. That leaves taxable income for US corporation of $50. The tax on that at 21% corporate rates is $10.50. Because they're entitled to what's called an indirect foreign tax credit, they can use the taxes that the CFC1 paid in its country of origin, country of establishment and country of operations, but it's limited up to 80% of those foreign taxes can be credited against the GILTI income tax as calculated for the corporation. Interestingly, it cannot be carried, any balance cannot be carried forward. So it's a use it or lose it option, okay? Which basically leaves us with US tax under GILTI of $2.50 on our 100. The total tax is the $10 that they were subject to tax in the foreign country under the US company's portion of the income, okay? Plus the $2.50 gets us to a rate on this GILTI income of 12.5%. Okay? For US individual person, they can deduct the $10 of foreign taxes, okay? Which leaves them with $90 of taxable income. On that $90 of taxable income, they are subject to a maximum tax rate of 37%, or a flat tax rate of 37%, which would leave a tax bill of $33.30. They're not allowed to take these indirect foreign tax credits, okay? So you end up with 0 foreign tax credits. So for a tax bill of $33.30, add in the foreign taxes of $10, and the total worldwide tax bill is 43.3%, which is completely insane and definitely not what, or at least I assume, not what Congress really intended. At this point, I'll open up the floor for questions, but I know these were very basic examples, and the solutions that surround them. Obviously, with GILTI, the goal to reduce the GILTI income in one way or another is one of the solutions. How to do that is on a case-by-case basis. Okay, for the transition tax, again, the specifics of each company need to be looked at individually in order to assess how do you potentially reduce the exposure there. Any questions?
Is it clear that tax has to be paid by whatever date, or can it just be shown on the extension?
It needs to be paid. The wording in the law specifically says it needs to be paid, and that if it's not paid by the extension date, it will disallow the election, or will cancel the election to split the tax over 8 years. Other questions?
Does the
Yes.
extension include the 15 October extension or not?
I'm sorry?
The
The extension for the filing of the election, you mean?
extension for filing a 1040.
It's all relates to the filing of the 1040, because we're looking at individuals here, okay? We're looking at the deadlines for individuals.
So we push everything to 15.
We're probably going to be pushing these tax returns all the way out to December 15th, as much, presumably, until the legislation is clarified, until our fight makes progress, until the forms are released. It's going to take time, and until the financial statements for the Israeli companies or foreign companies are ready, we're going to be well down the road and probably into these last extended 2 months between October, November, and December to get all these tax returns in. Yes.
You talked about non-cash assets.
Yes.
This may be a silly question, but what about appreciated real estate? Is that an issue?
You have to understand the calculation of the transition tax for cash or not. Sorry. Is limited to the net retained earnings. So you're going to look at what your net retained earnings are, look at your cash assets, look at your non-cash assets, and
Just look at the cash assets. Just look at the cash assets.
Why?
The balance is the other rate.
But let me give you an example. What happens if you have on your balance sheet, right? You have net. That's exactly what I was going to say. You have a company which has $100 of retained earnings. Okay.
Yeah, that's my limit.
That's your limit. But you have a $500 loan that you took money from. Okay. You now have cash in the bank. You haven't done anything with this loan. Okay. You could have cash in the bank of $500.
Netted against your current liabilities.
But the cash doesn't get netted. For purposes of the tax rate, you don't. The cash, the allocation.
Cash is a multi-definition, right?
Has a multi-definition. No, current receivables versus payables.
Okay.
But that's for your active business. That's not necessarily How do you know that the loan wasn't used for some sort of asset versus cash? So there's still there's a lack of clarity at the moment about how do you allocate if your E&P is lower, if your retained earnings are lower than your cash balance, or if your E&P is higher than your cash balance, that's fine. You know that the cash is on X level and the other assets are on another level. But what happens if your E&P is lower? And how do you allocate? Does it all go to cash?
Pays as if cash.
Potentially. But one might argue that really, I would look to argue, if you want to try to save your clients money, and I don't know, again, the methodology of how this is going to be allocated, but I could argue that some of my retained earnings relate to my assets that I've purchased, not the cash that I'm sitting in-house. So why do you take, cash first, non-cash first? Allocation of cash versus non-cash. There's a lot that's still unclear how that's going to be allocated. Yes? A husband and wife both have foreign corporations. They're both U.S. citizens, I assume. Okay? And you're filing jointly? I would assume that the answer is yes. I don't know that for a fact, but I could see that as a.
So we can possibly take advantage of that and perhaps add non-resident spouses who might have foreign corporations.
So some of the planning around non-resident alien spouses, if you make the election to treat the non-resident alien spouse as a U.S. taxpayer, you have to look at that extremely carefully, because the minute you bring that non-resident alien spouse into the U.S. taxation, you might fall into problems of Subpart F. You might fall into problems of PFIC. You might fall into problems that non-resident alien spouse has never been involved with before, and for all the benefits of the losses in the company to solve the problem of the transition tax, you end up basically creating a mound of other problems. So each case needs to be looked at extremely individually. And before I, go ahead. I was going to say, actually, I'll add my comment afterward, but go ahead.
Do you have an explanation why in the GILTI tax they allow the foreign tax credit for the corporations and not for the individuals? Because they're acknowledging that it exists and that it's legitimate.
It's just part of the legislation. Again, the logic of the legislation doesn't make sense for individuals bichlal at all. It's really the fact that they let it or don't let it. I don't think they were thinking about individuals when they wrote the legislation, but the way they wrote the legislation incorporated individuals into the rules. And the indirect foreign tax credit, in this case, doesn't apply to individuals. So,
It never did.
And it never did. Okay. One other area that I thought was an interesting question that came up for some of my clients. Yeah, go ahead.
Is she talking about ownership through attribution as opposed to, was that?
Well, you have attribution rules anyway.
Yeah, but we're not talking about ownership through attribution. We're actually talking about real interrelated company through.
We're talking about a husband has one company, a wife has a different company.
So how could you do that? It's ownership through attribution.
They file a joint tax return. I'm not sure.
But there would have to be corporate ownership.
One could potentially argue that because of local law, that they're each considered to be owners of each other's companies. There are a variety of ways to look at this, and again, I can't give a one-off answer. You really have to look at it on a case-by-case basis, maybe in conjunction with local law, in conjunction with U.S. law, and see if there's a way to take that position. I'm not saying by any definite manner yes or no, but it's an interesting thought for a potential solution. Another area that actually just I came across recently, thought about with regards to one of my clients, is the following scenario: an Israeli lives in Israel, not a U.S. citizen, non-resident alien. Okay, they decide to relocate to America in 2017. Prior to 2017, the Israeli owns an Israeli company. Okay, obviously, prior to the relocation to the States, the company is not considered a CFC, right? Because it's not owned by U.S. persons. However, and that company was an active company and has earnings and profits throughout the years in that company. The person now relocates to the States, stopped all activity in the company, okay, and now ends up in a situation where, by virtue of their residency in the U.S., they are deemed to now own a CFC, because the company is now owned by a U.S. person, right, has retained earnings that accrued prior to them being a CFC, and it becomes a question whether, for purposes of this transition tax, whether those accrued the accumulated earnings for that person get counted for purposes of the transition tax. And I haven't found any substantive answers to this, but I'm not sure that the IRS is even looking at that specific area, but for someone that deals with international relocations on a regular basis, the unintended consequences of a prior relocation and the corporate ownership can have some significant implications. I'll be around afterward to answer questions. I'd like to pass over the mic to